You know, the market doesn't hand out rewards for effort, it hands them out for discipline. You can sit in front of your charts for 10 hours a day and still lose if you haven't learned the real game that's being played. And that's what I want to talk about today, how to improve your win rate and your consistency in trading. If you remember the previous video on smarter trades, simple rule, you'll see how this fits right into that same current of thought. Because it's not about trading more, it's about trading right. Now let me tell you something that every new trader gets wrong. They believe winning more often is the same thing as being consistent. It isn't. You can have a 90% win rate and still go broke if your 10% of losses wipe out all the rest. The market doesn't care how many times you win, it only cares how much you keep. That's the arithmetic most people refuse to face. They're looking for excitement, not results. Tell me, do you want to be entertained or do you want to make money? The market has moods, just like people do. Some days it's patient, other days it's furious. If you don't learn to read its temperament, you'll always be on the wrong side of the tape. That's why consistency starts not with your strategy, but with your observation. You've got to study the market until you understand its language, not what the news says, not what some forum says, but what the price itself is whispering. Can you hear that? Most can't, because they're too busy trying to outsmart what they don't yet understand. I learned long ago that prices are never wrong. Your opinion can be wrong. Your timing can be wrong. But the tape never lies. When the market tells you you're wrong, the only sane thing to do is listen. Cut it and move on. Consistency doesn't come from always being right. It comes from always doing the right thing after you're wrong. That's the difference between a gambler and a trader. One wants to prove he's right. The other just wants to protect his capital so he can trade again tomorrow. Now, here's something that might surprise you. Improving your win rate isn't about finding a better indicator or a secret pattern. It's about cutting your losing trades faster and holding your winning trades longer. It's that simple, but it's also the hardest thing in trading. Most traders can't let go of a loser, and they can't let a winner run. They do the exact opposite. They nurse their losses and strangle their profits, and they wonder why their equity curve looks like a heart monitor. Tell me, have you ever done that? Held on, just hoping the market would come back to you? Let me put it this way. Every great trader learns to trade less, not more. The amateur thinks that more trades mean more opportunity. The professional knows that more trades mean more exposure to mistakes. Patience pays. The best trades don't come every day. Sometimes you wait a week, sometimes a month, but when that setup appears, when the price and the volume and the trend all line up, that's when you strike. You don't hesitate. You don't ask for confirmation from 10 other traders. You trust your read of the tape. And this ties right back to that lesson from Smarter Trades. Simple rule. Remember how we talked about simplicity being your best defense against confusion? The same applies here. Simplicity breeds consistency. The fewer moving parts your system has, the fewer things can go wrong. Don't let your charts look like a Christmas tree. 1 or 2 good indicators, clean price action, and disciplined execution, that's all you need. Now, let's talk about mindset, because no technique will save you from a weak temperament. The market tests your nerve. It will show you how patient or impulsive you really are. You might have a perfect entry, but if you can't sit still, you'll sell too early. You might have a perfect setup, but if you're afraid to pull the trigger, you'll miss the move. And that fear, that hesitation, it comes from not trusting your plan. You can't be consistent if you're trading from emotion. Tell me, are you trading your plan, or are you trading your feelings? You have to treat trading like a business. Every trade is a cost, every loss is a line item, every win is revenue. If you can't manage your losses like expenses, you'll never grow your account like a business. That's where most traders fail. They let small mistakes become emotional disasters. When you take a loss, take it clean. Don't average down, don't argue with the market. The market doesn't know your name, and it doesn't owe you a cent. Here's another thing most traders never understand. Consistency comes from routine. You've got to build habits that keep you grounded. Wake up at the same time, scan the same tickers, record every trade. Keep a journal, not just of entries and exits, but of what you were thinking. Were you calm? Were you chasing? Were you disciplined? That's how you'll find the patterns that destroy your consistency. The market will always test your method, but your mind is what fails first. When I was learning, I'd sit with a notepad beside my ticker tape. I'd write down the prices, the movements, the volume, everything. I wasn't trying to predict, I was trying to understand. That habit built my intuition. Over time, I could feel when a move was real or false. You can't get that from indicators alone. You've got to live with the market long enough for it to speak to you. And if you want a higher win rate, you've got to learn when not to trade. The hardest part of trading is waiting. But waiting keeps you out of bad trades. That's where consistency is built, in the moments you do nothing, because doing nothing is still a decision. It's a sign of control. Most traders lose because they can't stay out when the market's unclear. They'd rather trade noise than sit in silence. But silence is where clarity comes from. Remember, you don't have to win every battle to win the war. Protect your capital, trade only the best setups, and respect the market's rhythm. Your goal is not to conquer the market. Your goal is to survive long enough to understand it. And once you understand it, the profits follow naturally, without strain, without chasing. Now think about this. Are you trying to predict the next tick, or are you trying to position yourself for the next big move? There's a world of difference between those two. One is gambling, the other is trading. And the trader who learns the difference, who stays patient, disciplined, and sharp, he doesn't just improve his win rate. He becomes consistent, unshaken, ready for anything the market throws at him. Treat trading like a business, not a gamble. That's a line most traders nod to, but few truly understand. It sounds good when you say it, but when the screen starts flashing and prices jump, all that logic goes out the window. The truth is, until you start handling your trades the same way a shopkeeper handles inventory, or a manufacturer handles costs, you'll never see consistent profits. Because trading, at its core, is a business, one where your inventory is capital, your expenses are losses, and your product is disciplined execution. Most people come into trading with a gambler's mind. They want the thrill, the rush, the quick win. They're chasing the emotional high of being right, instead of the financial reality of making money. And that's why they lose. Tell me, would you open a restaurant without knowing your food costs, your rent, your profit margins? Of course not. But traders do the equivalent of that every day. They take trades without knowing the risk, without calculating position size, without understanding what they stand to lose. That's not business. That's hope, and hope is the most expensive emotion in the market. When you start treating trading like a business, everything changes. You begin to think in terms of process, not luck. You have a plan for your entries, your exits, your risk, your capital allocation. You stop thinking about one trade and start thinking about 100 trades, the series, the long run. Businesses don't measure success on a single sale. They look at quarterly and yearly performance. A trader should do the same. You can have a losing day and still have a winning business if your structure and discipline are intact. In a real business, expenses are controlled. You don't let them spiral out of proportion. That's what stop losses are, for they're the trader's expense line. When a trade goes wrong, that loss is the cost of doing business. You don't double down to make back the money. No real business throws more money into a bad deal to justify it. You take the loss, record it, learn from it, and move on. If you let your losses grow because of ego, you're no longer a trader, you're a gambler at the table, chasing a hand that's already beaten. And think about this, every business has inventory control. A trader's inventory is their capital. You must know where every dollar is, what it's doing, and how much it's producing. If you're risking too much on one trade, that's like tying all your company's funds into one product line. If it fails, you're out of business. Diversify smartly, manage your capital wisely, and never overexpose your account just because a setup feels right. Businesses don't run on feelings, They run on numbers. When I was learning the market, I treated each trade like a project. I'd calculate the cost, set the limits, and determine the potential reward before I ever clicked the button. That habit kept me from overtrading. You wouldn't open 10 stores in a week just because business was good on Monday. You'd wait, analyze, and grow at a pace you could handle. That's how you should scale in trading. Gradual, deliberate, measured growth. There's another key difference between the gambler and the business operator: accountability. A real business keeps books. They track revenue, losses, expenses, performance metrics. Do you track your trades that way? Do you know your average win, your average loss, your most profitable setups? Most traders don't. They remember the big winners and conveniently forget the big losers. But data doesn't lie. If you want to improve your win rate and your consistency, you need to run your trading book like a financial statement. Review it weekly. Adjust your methods based on the numbers, not your emotions. In business, mistakes cost money, but smart owners turn them into lessons. In trading, every loss should teach you something. Maybe your entry was too early. Maybe you ignored the trend. Maybe you let hope override logic. Whatever it was, write it down. Treat it like an expense analysis. When you review those notes later, you'll start seeing patterns, the same mistakes repeated. That's where improvement begins. The gambler forgets his losses, the trader studies them. And let's talk about revenue. A business doesn't rely on one product or one client to stay afloat. It builds multiple reliable streams of income. The same principle applies to trading. Don't depend on one setup or one time frame. Develop 2 or 3 proven strategies that perform under different market conditions. When the trend slows, maybe your breakout setup stops working, but your mean reversion strategy kicks in. That's diversification within your business model. The gambler can't adapt, but the business-minded trader always has another product on the shelf. Now, no business can run without cash flow. The trader's cash flow is capital preservation. You must always have enough to keep operating. Never risk so much that one bad week wipes you out. If you can survive the slow seasons, the choppy markets, the losing streaks, you'll be around for the profitable ones. That's what separates the professional from the novice. The pro is always thinking about staying in the game. The novice is always trying to double the account. Another thing about businesses: they plan for taxes, for slow months, for supply shortages. The trader must plan too. You should have an emergency reserve, not just for life but for your trading account. You need mental reserves as well, discipline and patience for when nothing seems to work. A business doesn't panic when sales dip for a week. It looks at the broader trend, adjusts the model, and waits for the cycle to turn. The trader must do the same. You see, the gambler asks, "What can I make today?" The business operator asks, "How can I grow this operation sustainably over time?" One seeks a thrill, the other seeks longevity. And that single difference in thinking defines who survives in the market. Because in the long run, the only traders who last are the ones who run their operation like a business with structure, control, patience, and relentless discipline. Emotional control is more valuable than technical skill. You can master every indicator, memorize every chart pattern, and still lose if you can't master yourself. The market doesn't test your intelligence, it tests your temperament. Every tick, every fluctuation, every false breakout is designed to pull on your emotions: fear, greed, impatience, hope. Those emotions are what the market feeds on. Tell me, have you ever had a perfect setup fall apart just because you couldn't sit still? That's not bad strategy. That's emotion doing the trading for you. Most traders believe their edge lies in finding a better system, a sharper entry, or a new algorithm. But your true edge is psychological. Because no matter how advanced your system, you're still the one pressing the buttons. If you hesitate when you should act, or hold when you should cut, your emotions are the weak link. The chart doesn't care about your hopes or fears, it only reflects them back to you. That's why the same setup that makes one trader rich can destroy another. It's not the method, it's the mind behind it. When you watch the tape, you're really watching a mirror of mass emotion: greed rushing in, fear pulling out, panic, euphoria, hesitation. The market is nothing but a reflection of human behavior, and your job as a trader is to not be part of that crowd. You can't ride every wave of excitement or terror that moves the price. You've got to be calm while others are frantic. Because the moment you start feeling what everyone else feels, you'll do what everyone else does, and that's exactly how the majority loses. The strongest traders are not the smartest ones. They're the ones who stay steady when everything else shakes. They know that emotion has a cost, and that cost shows up in poor execution. Fear makes you close too early. Greed makes you stay too long. Impatience pushes you into trades that don't deserve your capital. Hope keeps you in losers that should have been cut hours ago. Every emotion translates into a mistake on the chart. And until you learn to separate feeling from decision, you'll always be on the wrong side of your own impulses. Control doesn't mean suppressing emotion. It means understanding it. You can't pretend fear isn't there. You just have to stop letting it make choices for you. When you feel that urge to close a trade just because the candle turned red, ask yourself, is that my system talking or my nerves? Most of the time, it's your nerves. The disciplined trader waits for his plan to confirm, not his comfort. Because comfort is an illusion the market sells to those who want to feel right instead of be right. Emotional control also means learning to accept loss without resentment. Losses are not personal, they're operational. They're part of the business, part of the process. The trader who gets angry after a stop out starts to fight the market, and no one wins that fight. The market has more money, more patience, and more time than you do. All you can control is how you respond. That's why you have to train your reactions like a soldier trains for battle, with repetition, with structure, with awareness. When your stop hits, you exit. No debate. No emotion. Just execution. When I first started trading, I'd let one bad trade ruin my whole day. I'd start taking impulsive positions just to make it back. That's the gambler's spiral: emotion chasing loss, loss feeding emotion. It took years to learn that revenge trading is nothing but self-sabotage. You don't get even with the market, you just dig a deeper hole. The only way to recover from a bad trade is to stop trading until your mind is clear again. Because emotional recovery is as important as capital recovery. And here's the thing: emotional control is built in quiet hours, not in chaos. You don't develop it by staring at charts all day. You develop it by having routines, by taking care of your health, by staying balanced outside the market. A clear mind makes clear decisions. If your life is disorganized, your trades will reflect that. You can't expect calm in the charts if you live in constant noise. Trading rewards those who learn to be still, not just in action, but in thought. You'll also find that emotions become louder when you risk too much. Oversized positions amplify fear and greed. If one trade can ruin your account, you're already trading emotionally before you even begin. Proper risk control is emotional control in disguise. Keep your position sizes small enough that a loss doesn't sting your ego or your wallet. That's how you stay objective. When your mind isn't anchored to the outcome of one trade, you can see the market for what it really is, not what you wish it to be. Another key to emotional discipline is patience. The market moves in its own rhythm, not yours. You can't force a setup to appear just because you want to trade today. Impatience is the emotion that drains accounts quietly. It makes you take mediocre trades because you can't stand waiting for perfect ones. Every professional trader has learned this lesson the hard way: waiting pays more than acting out of boredom. Tell me honestly, how many bad trades have you taken just because the market looked too quiet? You must also remember that emotions don't vanish with experience. They just lose their power over you. Even the best traders feel fear and greed. The difference is they recognize it early and don't act on it. They have learned to let the feeling pass without translating it into movement. Like waves on the shore, emotions will always come. You just have to learn not to drown in them. It takes discipline to stay detached from results. After a winning streak, you'll feel invincible. That's when greed and overconfidence sneak in. After a losing streak, you'll feel cursed, desperate to prove yourself. Both states are dangerous because they tilt your judgment. The market loves emotional traders. It takes their money faster than they can click a button. That's why consistency begins with neutrality. You must approach every trade with the same calm, whether you've been winning or losing. And just like in the previous video, smarter trades, simple rule, this idea connects deeply, because simplicity isn't only in your charts, it's in your mind. The simpler your mental state, the cleaner your decisions. Strip away the noise, the fear, the euphoria, and what's left is clarity. That clarity is what separates the professional from the amateur. The truth is, your biggest opponent in trading isn't the market, or the big institutions, or some invisible algorithm. It's you, your impulses, your need for action, your fear of missing out. Every trader eventually learns that success isn't about mastering charts, it's about mastering yourself. Once your emotions stop dictating your trades, your decisions become sharp, rational, and aligned with the tape instead of your mood. That's when real consistency begins to appear, quietly, almost invisibly, until one day you realize you're no longer reacting, you're simply executing with calm precision. Protect capital first, profits are a byproduct of survival. That's the foundation of every trader who's lasted long enough to call this a career. You see, most traders chase profits from day one, but the professionals, the real survivors, they chase preservation. Because if your capital disappears, the game is over. You can't recover from zero. The market gives opportunities every day, but it only gives them to those who still have chips on the table. Tell me, what good is a brilliant setup if you've already blown your account trying to catch the last one? Every trader comes into the market dreaming about gains, the big move, the life-changing trade, the fast success story. But those stories are rare because they skip the boring part, defense. Protecting your capital doesn't sound exciting, but it's the single skill that separates the professional from the gambler. The amateur measures success by how much he makes. The professional measures it by how much he keeps. And believe me, keeping is harder than making. When you protect your capital, you're protecting your opportunity to play another day. You're preserving your position in the game. Think of trading like war. Your money is your ammunition. You don't fire at every shadow. You wait until you have a clear target. You don't attack when you're outnumbered. You wait until the odds favor you. That's how you stay alive in the market. You don't win by fighting every battle. You win by surviving the long campaign. Capital protection starts with risk management, and risk management starts with humility. You must accept that you can be wrong often, repeatedly, and unexpectedly. The market doesn't reward ego. Every trader who thinks he's smarter than the tape ends up learning the same lesson. The market always gets the last word. That's why you must define your risk before you ever define your reward. Decide how much you can afford to lose on a trade, not emotionally, but mathematically. Because your emotions will lie to you, but numbers won't. Every loss you prevent is as valuable as every profit you gain. The money you don't lose compounds the same way as the money you make. That's the quiet truth no one likes to hear. People love talking about wins, 50% profit here, 200% there, but they never talk about the drawdowns that wiped out those gains. The path to consistency isn't paved with spectacular profits. It's paved with small, controlled losses and protected capital. Protecting your capital also means avoiding unnecessary trades. Not every movement in the market deserves your participation. The best traders sit out when conditions are unclear. They don't feel pressured to be in the market at all times. You can't control when the market will give you a good setup, but you can control whether you'll waste capital on bad ones. That's the essence of discipline, waiting for quality instead of forcing quantity. Have you ever noticed that your biggest losses usually came from trades you took out of boredom or frustration? That's the price of impatience. And it's not just about stop losses or position sizing. Protecting capital means protecting your mental capital too, because every big loss doesn't just drain your account, it drains your confidence. Once your confidence is damaged, your decision-making suffers. You start hesitating, second-guessing, overreacting. That's how one bad trade becomes 5. The smart trader knows when to step back, take a break, and come back clear-headed. You're not protecting just dollars, you're protecting your ability to think clearly. When you prioritize capital preservation, you start seeing trades differently. Instead of asking, "How much can I make?" you start asking, "How much can I lose if this goes wrong?" That single shift in mindset changes everything. You begin to trade from a place of control instead of hope. Hope has no place in trading. Hope is what gamblers rely on when the odds are already against them. Traders rely on probabilities and control. In the long run, your account balance tells the story of your discipline. A trader who survives year after year isn't the one who found a magic system, it's the one who learned not to die from his mistakes. Every large account you see was built through small risks repeated intelligently. Every blown account was destroyed by one or two careless bets. The market punishes recklessness quickly and silently. Protecting capital also means keeping leverage in check. Leverage is a double-edged sword. It multiplies profits, but it multiplies mistakes faster. The inexperienced trader sees leverage as opportunity. The experienced trader sees it as danger. Trade small, stay liquid, and never risk the house to win a room. The goal isn't to impress anyone with big position sizes. The goal is to stay in the game when everyone else gets forced out. Another part of protecting your capital is understanding drawdowns. Every trader faces them. It's not a question of if, but when. During drawdowns, the worst thing you can do is fight harder. The best thing you can do is trade smaller or stop trading until the market shifts back into alignment with your system. A soldier doesn't charge uphill when the fog is thick, he waits for visibility. The market is the same way. When it's choppy, uncertain, uncooperative, your number one job is to preserve what you've built. And remember what we discussed in the previous video, smarter trades. Simple rule, the concept of trading with clarity and simplicity. That same principle protects your capital. Complexity breeds confusion, and confusion breeds mistakes. Simple rules, defined risk, clear entries, planned exits are the armor that keeps your capital safe. You don't need a dozen signals to stay protected. You just need discipline to follow the few that matter. You must also understand that cash is a position. Sitting out is a trade. There's strength in restraint. If the market's uncertain, if your confidence is shaky, holding on to your capital is the smartest move you can make. Patience keeps your account alive. Recklessness drains it. The trader who knows when not to trade often earns more than the one who trades every day. Because every dollar saved in a bad market becomes a dollar available in a good one. And there's another layer to protecting your capital, your mindset about wealth. You must think like a custodian, not a speculator. Your capital isn't just trading money. It's your livelihood, your foundation, your future. Treat it with respect. Don't throw it at uncertainty because of greed. Every dollar should have a purpose, every trade a reason. When you protect your capital with that kind of respect, you stop gambling and start building. The market rewards those who endure. It tests your patience, your composure, and your discipline. There will always be another trade, another move, another cycle. But none of them matter if you don't survive the current one. The trader who protects his capital, who guards his account as carefully as a businessman guards his assets, will always have another chance to win when the time is right. Because in trading, survival isn't just part of success, it is success. Consistency starts with disciplined observation, not prediction. Every trader wants to know what's going to happen next, where the price will move, when the breakout will come, how far the trend will run. But the truth is, prediction is the weakest part of trading. Observation is the strongest. The traders who last aren't the ones who try to forecast every tick. They're the ones who learn to watch the market quietly, patiently, until it reveals its rhythm. The tape always tells the truth to those who listen long enough. Tell me, are you really observing the market, or just searching for confirmation of what you want to see? The difference between prediction and observation is the difference between guessing and understanding. Prediction is ego, it says, I know what will happen. Observation is humility, it says, I'll wait and see what's happening right now. The market doesn't reward arrogance, it rewards clarity. when you watch without bias, when you stop trying to force your opinions onto the chart, you begin to see patterns others miss. You start noticing how the price behaves before a breakout, how volume swells quietly before a move, how the character of the market changes before a reversal. Those clues are everywhere, but you can't see them if you're obsessed with proving you're right. Every great trader I've known built their edge on observation. They studied how prices move in different conditions, quiet consolidations, volatile breakouts, trending markets, dead markets. They didn't chase signals, they studied behavior. Because charts are just human emotion in numbers, fear, greed, hesitation, and conviction drawn in price and time. The more you observe, the better you understand how those emotions flow. And once you understand that flow, you don't need to predict anymore. You simply align yourself with what's already happening. Most traders lose because they trade too soon. They look at a setup, get excited, and jump in before the move confirms. That's prediction at work. The disciplined observer waits for the market to show its hand. He lets the pattern complete. He waits for the price to prove its strength. That patience builds consistency.